All right, good afternoon, members, and thank you for joining us on this webinar. This is the first PSSF webinar. We intend to have a series of this webinar. Thank you for attending this one. Sorry, we still have some members that are waiting in the lobby, and we'll be admitting them into the meeting as we proceed. My name is Gumbo Njoroge, a member of the PSSF Secretariat. I want to welcome you for this webinar. Part of a conversation that we intend to have with our members, just to appraise you on a number of issues, including how you can get access to information around your contributions, and also addressing the frequently asked questions that we've been getting from the membership. So we'll have a 1-hour conversation today that we have structured into a presentation for about 25 minutes. Then we'll take questions for the rest of the hour. So we'll have members of the Secretariat, Douglas Asanyo, who has joined us with making a presentation for about 25 minutes, just to help us appreciate the background of the scheme, where we have come from, what informed the establishment of the scheme, who are the members of the scheme, how much do you members contribute to the scheme, how much have you contributed since the operationalization of the scheme in 2021, and where has the scheme invested your money? We are also joined by our Chief Executive Officer, the Benefits Department. So thank you, members. As I said, my name is Gumbo, a member of the Secretariat. Karibuni sana. I want to invite Mr. John Muli, who is from our Registration and Benefits Department, just to make a few remarks, and invite our CEO.
Thank you very much, Mr. Njoroge, and good afternoon, members.
Thank you.
My name is John Muli. I'm a senior manager in the Registration and Benefits Department. Indeed, today, as Mr. Njoroge said, excuse me, we are very delighted that you could join us for this conversation. We have been receiving a lot of inquiries in our platforms, mostly the social media platforms. And therefore, we thought that we could probably have a conversation where we interact one-to-one and be able to address some of the issues that have come up. That notwithstanding, when we started this scheme, we started collecting money from your pay slips. And therefore, as a call of duty and as a requirement of law, we are supposed to come back to you and sensitize you regarding how we are managing your retirement benefits. And therefore, we are very glad to be doing that today. And with just a start of a conversation that we are going to continue with. Our idea is to have as many members as possible understand the scheme so that when it comes to the time of retirement, you have a seamless transition from your working life to your retirement. Now, I just want to encourage all of us, let's engage each other. We have a chat box where you can drop in your questions. If you have any concern, question, or a comment, kindly feel free to drop it down in the chat box. And we have a team that is going to respond to you and we'll take your comments as well so that we can improve on our services. So thank you very much for turning up. Allow me to invite our head of the Secretariat, Dr. Jonah Ayabe, to make his opening remarks and officially open the webinar. Dr. over to you. Asante.
Thank you very much, John, and Gumbo, and all the members of Secretariat who are present today. Members of our scheme, we are delighted that you have managed to join this inaugural webinar, which we are running for the first time, and we will also be organizing regular engagement through this approach. We will be leveraging on technology. In the past, we have organized physical meetings whereby we could meet stakeholders physically and have one-to-one engagement. But we do realize that because of the numbers that we are dealing with, which are over 400,000, we need to make use of the technology. And out of this, we'll be able to get what we are doing for you and what you can actually be able to benefit from the scheme. I also wish to mention that today in this inaugural seminar or inaugural webinar, our board of trustees are also listening through. So really, we are all available to serve you as our members. Noting the time that we have for this seminar or webinar, I would want to allow the technical team to take us through on the key issues of discussions. And once again, feel free as members to raise questions, seek clarifications, because we exist because of you as a member. The board of trustees exists to serve you, and everything is actually confined towards serving you as a member. So really, this is your scheme. This is your time. This is the first webinar, and we'll have many, many others coming beyond this. So I wish to hand over to our presenter for today, who is Douglas Asanyo. I want to hand over to him so that we can only wait to come in later to answer questions, if any. Thank you, and have a pleasant day.
Good afternoon, members. I want to appreciate our CEO and the Board of Trustees for allowing us to plan this inaugural webinar, which is the start of the many engagements that we'll be having with members. I know previously we've been engaging our members through fiscal meetings, and there are also those who have been engaging us on Facebook and Twitter. They've been sending questions, concerns, which have all been addressed. So I'll delve straight into our discussion of the day, where we are looking at a few issues. Where we are looking at the background of the scheme. We look at the membership, current contribution rates, and they also look at how far we are, the total contribution so far since we began, and also how our members can access their statements. And also we'll also look at additional voluntary contributions. And lastly, we'll engage in the question and answer session, which will be handled by my colleague who introduced himself earlier, Mr. John Muli. He will coordinate that. So here we are. The Public Service Superannuation Scheme commenced in January 2021 through operationalization of the Public Service Superannuation Scheme Act number 8 of 2012. This act introduces the contributory pension scheme, which is a contributory design in nature, a complete departure from the defined benefit scheme, which is anchored under the CAP 189, the Pensions Act CAP 189, which we've always known until 1st January 2021, when the scheme commenced. This act or this pension scheme, the contributory pension scheme, is impacting members positively, which is also a departure from the past where we've been. We know of the delays, and we are saying now that the money is available, it's your money, and you're tracking your money, which is actually invested and safeguarded by the Board of Trustees and that delegation coming to the Secretariat. So we endeavor and we promise that we'll do a timely and sustainable payment of pension benefits when members exit. And this is actually done within 30 days of exit of a member, meaning that in the event that an officer retires, in under 30 days, they're able to access their benefits. We are also going to see a progressive reduction of the pension liability wage bill, which is currently, which has risen exponentially from even 10 years ago, 5 years ago, to an upward of 150 billion. And this contributory scheme also now impacts us in a way that we have a say, as a member, we have a say on how we determine our pension benefits on how the scheme is run. Unlike the old arrangement where you have to wait until retirement, that is when you get to know what is payable to you. We have several ways of how a member will participate. This is one of them, especially these webinars, AGMs, through the statements, through looking at the financial statements and all that. So we have several avenues in which members can always engage with the scheme. This scheme, the Public Service Superannuation Scheme, is managed by a board of trustees, and this is the scheme governance structure. We have the trustees at the top, taking care of everything. And government, as a sponsor, is the one that established this scheme through initiation of the legislation that culminated in the passing of the Public Service Superannuation Scheme Act. The trustees are appointed as per Section 10 of the PSSS Act. And then below that, we have a CEO who heads the secretariat. The CEO reports to the Board of Trustees and is also the secretary to the board. The trustees don't do this job alone because they also need professionals as per the regulations of the Retirement Benefits Authority, which regulates this industry. We have the fund manager, we have the custodians, and the fund administrator. I will briefly explain what these three service providers do so that we get to understand how our money is managed. Immediately, a member contributes and the employer remits together with the employer contributions. The money comes to the custodians. And these custodians are majorly banks who are regulated by the Retirement Benefits Authority and also the Central Bank of Kenya. And we have the fund manager. Because this money doesn't sit with the banks, we need our members to get returns on their benefits, on their contributions, so that at the time of exit, it is not only your contribution that you get, but also the investment income out of your contributions. The investment income is what I can call either profits from your contributions or dividends, as we call it for those in SACCOs. Then the fund administrator is the one who maintains your retirement savings account. Every month, once your employer remits your employee portion of the contributions and the employer contributions, this amount is credited to your retirement savings account, which is maintained by the fund administrator. So at the end, even where the fund manager now invests and gets a return on investment, those investment income is also credited to individual savings account for each member at the end of each financial year. So that is the scheme governance structure. Headed from top, the trustees, CEO, secretariat, and those service providers who are engaged on a contractual basis, and their terms are renewed every 3 years based on performance. This scheme covers the following employees in the public sector, public servants who are in the employment of Public Service Commission, that is the civil servants. We have teachers employed by Teacher Service Commission, and then we have the disciplined services, that is the National Police Service, Prison Service, and the National Youth Service, and any other service that the CS, that is the Cabinet Secretary National Treasury, that may determine to be public service for purposes of the Public Service Superannuation Scheme Act. In this sense, it means that if there is another public entity that wishes to be a member to this Public Service Superannuation Scheme, then the CS will approve of that together with, in consultation with the board, so that those members are admitted. And if you see from my screen, then you'll see that we started this scheme in 2021 January with a membership of 331,000 members. And these are members who are below 45 years of age as at commencement. These members were previously in the old arrangement where it was non-contributory. So by operation of the Act, these members became automatic members to the scheme. That number has since grown, and as at the end of April 2024, we had 429,221. So the scheme is growing. It has grown almost 100,000 by 100,000 since we began 3.5 years ago. The rates of contribution, we have employees contributing 7.5% and the government contributing 15%. This percentage is based on the basic salary, which is the pensionable emolument. And then the employees have an option to make additional voluntary contributions to the scheme for their own retirement. However, you may note that the government will not match the additional voluntary contributions. The employee or the member of this scheme is allowed to make additional voluntary contributions beyond the 7.5% that is allowed in the Act. In this sense, if you wish to make additional voluntary contributions to increase your retirement savings so that you have a decent payout at the time of exit, then you can make any additional voluntary contribution above the 7.5%, and this should be an absolute figure, either 5,000, 10,000, whichever as your payslip can allow, of course, subject to their third rule or on your payslips. In this sense, then you may need to, when you have an option and you wish to give additional voluntary contributions, you download the form from the PSSS website or the employer's website, like the Public Service Commission website, National Police Service Commission website, and Teacher Service Commission website. There is the additional voluntary contribution form, which you will complete and submit to your employer, because they're the ones managing your payroll, so that you can give those contributions. And remember that these contributions can be varied at any time. Assuming you are giving 5,000 now, and in another year you are unable to, or you want to increase, so you also download the form, give the new instructions to your payroll, so that contribution can come through to boost your savings for retirement. So members, you may note that unlike the old scheme where we depended on a formula, this one, an employee or a member of this scheme can boost their savings, so that at the end of the day, when you exit the service, you have more benefits. Employees or members at the same level, same salary, will actually exit the service with the different benefits, because one is giving additional voluntary contributions. The scheme assets have significantly grown from the time we started with zero savings on 1st January 2021 to at the end of April 2024. The scheme has an asset base of Kenya shillings 126 billion. And this is money that is invested majorly in government securities, quoted equities, coal and fixed deposits. And then the Board of Trustees has already approved, or actually developed and approved, an investment policy statement that will guide diversification of the investments, so that members can get a decent return from those investments. Let's look at the benefits that are provided by the scheme. We have a lump sum not exceeding 1/3 of the balance in the savings account, meaning that at the time of exit, if you have 3 million shillings, then you can take up to 1 million shillings as your lump sum, and the balance will be utilized for a monthly or quarterly annuity for life. So in this sense, we are saying you'll still have a lump sum and you still have a monthly or a quarterly payment for life. And this monthly or quarterly can either be accessed through annuities or through an income drawdown where you are doing a monthly or quarterly withdrawals from that income drawdown. In addition to these benefits, the PSSS Act, in the wisdom of the drafters, promised, and now the government or the employer has given that benefit of the group life cover. You may note that members now, the employer has already started providing for the group life cover so that in the event of death of a member, your beneficiaries are eligible for a minimum of 5 times your annual pensionable emoluments that is payable to your beneficiaries in the event of death. And this benefit is only accessible or accessible if that death occurs while you're in employment. But at the time of exit, you get your lump sum, you get your monthly from those 2 categories that I highlighted. Now, how do you get to access your benefits so that you can track your savings so that at the time of exit from service, you're able to tell how much you expect. And this money is what we said that within 30 days, we'll be able to make payment on. You have 2 options. You either log in through the USSD code by dialing *378#. If you dial that, then you'll be prompted to log in, especially for the first time. You'll be asked of your email address and the ID number. Then you're able to log in to access. This is provided so that no other person is allowed to access unless you are a member of this scheme. So the code is only used by members of the scheme. Alternatively, you can access through a link, members.psss.or.ke. And this link is provided in our website, so you can access either through the members.psss.or.ke or the USSD code, that is the *378#. Let's look at the procedure of accessing benefits. It's not a long process, it's a short one, so that we're able now to make payment within 30 days of your exit. So upon exit of a member, you lodge a claim through your employer. And upon receipt of that application, the scheme will review its completeness and will forward to the administrator for calculation of the benefits and then make payment. This calculation of the benefits is now where we look at what you want to commute to get as a lump sum and the remainder to be utilized to give you an annuity or through a regular income from an income drawdown plan. Then the scheme will make this payment within 30 days of receipt of the complete application. It's a simple process. You don't need any other documentation apart from what is provided for on the forms that are provided on our website and from the websites of the previous employers participating in this scheme. And I'm almost coming to the end of this presentation before I invite my colleague to handle the question and answer session. We've planned for the 2nd annual general meeting. Most members attended the inaugural first annual general meeting that was held at KICC and beamed live at KBC last year, 30th June. And now for the year ended 30th June 2023, the Board of Trustees have organized for an annual general meeting for the members. And this will be held at KSG, and the members will be allowed to Just a moment. I'll get back online shortly. I want to handle a technical challenge, then I get back to you shortly. Now, members, as I conclude, the trustees have organized and is welcoming all members to join physically and virtually. Physically, of course, we have representation because of the size of the venue, but members are encouraged to attend virtually through our Facebook page and Zoom, and the link will be provided. The link is beamed as you can see, but then immediately after this presentation, that link will be uploaded to the various websites and the social media platforms, so that on the 7th of June 2024 from 8 a.m., members can follow through, send in their questions, especially through Facebook, so that you can engage your trustees and get to know how your scheme is being managed. So I want to end there and then hand over to my colleague, Mr. John Muli, to go through a few questions that you've been raising so that we get to understand our scheme better. Thank you.
Thank you very much, Douglas, for your presentation. It is our expectation that at least it has managed to shed some light to members on their benefits and the scheme at large. So I'll go on to just share a few questions that we have been receiving on our social media platforms. We have sampled a number. Of them, and we just wish to share these questions with you and our response. We realize that when we engage through chats, we are not able to maybe answer you as well as we should, and therefore that's why we sought this webinar, so that we can try and address them to a satisfactory extent, hopefully. So I will share. These questions. Douglas, could you kindly confirm that you can see the questions on the screen?
Yes, we can. Proceed.
Thank you very much.
Yes, we can see.
Thank you. So this is the first question that we have been receiving so frequently. And the question is, what will happen to the WCPS? Now, WCPS means Widows and Children Pension Scheme contributions. Now, members, you'll appreciate that a majority of you joined this scheme from a previous pension arrangement. That pension arrangement used to offer two forms of benefit. One was the CAP 189 benefits, and the other one was the WCPS, or the Widows and Children Pension Scheme benefits. The Widows and Children Pension Scheme benefits were offered to mostly the male officers who are contributors, so that in case of their demise, the benefits would be paid to their beneficiaries and dependents. So the question that we have been receiving is what will happen to those contributions that the male officers, majority of them were making to this scheme. So by the law that established us, that law closed the WCPS scheme, and these officers will realize that contributions to WCPS were frozen or they were seized from 1st January 2021. However, these officers have made contributions to that scheme, and the law requires the sponsor of the scheme, who is the national government, to determine these benefits and pay them to the members once they retire. So there is a provision in law. Currently, we are still trying to refine that provision in law so that we create a very clear framework on how these benefits will be paid. However, I want to give you assurance that these benefits are protected, and once you exit from service, they will be payable to you. The second question is, how will members' contributions and investment be protected? Now, Douglas has attempted to answer this question, but probably I can give some more information on this one. So when members make contributions to the scheme every month, these contributions are deposited to your accounts. We have created an account in the name of every member. And we will invite the administrator to just quickly demonstrate how members can access their statements. So when those contributions are deposited to your account, they are invested immediately by a professional service provider that the Board of Trustees has appointed. And this provider is the fund manager. The fund manager is regulated by the Retirement Benefits Authority. So there is an authority or a regulatory body that supervises how your investments are, or how your funds are invested. Secondly, the scheme itself, the Public Service Superannuation Scheme, is a scheme that is registered and regulated by RBA. So we have a registration certificate. We file statutory reports to RBA, and therefore the regulator keeps on monitoring how your savings and investments are being managed by the Board of Trustees. Then lastly, the Board of Trustees itself is mandated by law to ensure that they manage your funds prudently and uphold a duty of care. So the Board of Trustees, every time they sit, their core mandate is to ensure that they protect your benefits and they ensure that they are invested properly so that they can earn you value for money. And then just to mention is that in the Board of Trustees, members are represented. They are represented through their unions. We have a union for the Kenya Civil Servants. We have the union for teachers, both KUPPET and NAT, who sits in the Board of Trustees. Now, these unions, the three of them, represent you members, and therefore the trustees who sit in the board on your behalf, they are there to protect your interest as members. That said, all trustees, even the ones that are appointed by the sponsor, they are required by law to ensure that they maintain the safety of your benefits at all times. The third question is, what is the procedure for accessing benefits? Douglas has alluded to this. So members, when you exit from service, your first point of call is your employer. You launch your benefit through, you are applying for benefit through your employer. Your employer forwards your documentation to PSSS, where we process your benefits together with the pension administrator. And we are required by law to ensure that we pay you your benefits within 30 days. We have made a lot of attempts to comply to these guidelines. This is part of the timelines that the regulator expects us to comply with. And so far, I can say we have really tried to catch up with those timelines to ensure that we process your benefits within 30 days. The commitment of the scheme is to reduce this even further to 21 days. And therefore, we shall continuously endeavor to pay your benefits within a very short time upon your retirement. We want you to have a continuation of income. You exit from salary to a pension arrangement in a very seamless manner. And therefore, we commit to pay your benefits in a timely manner. The fourth question is, what will be the formula used to calculate your benefits in the scheme? Now, this scheme, unlike the other scheme, which had a pension formula, which was applied to determine your benefits, in this scheme, the formula is your savings. The formula is how much you've contributed to the scheme plus what the employer has contributed for you, plus the investment income that the fund manager declares on your account every year. Remember, we said that your money is invested. So every year there's a return that is declared by the scheme. The Board of Trustees, one of the obligation is to ensure that these monies are invested in asset classes that give you a decent return. And therefore, once we declare this return together with what you invested through your monthly savings and what the employer has invested for you, this is what will form your retirement benefits kitty. And therefore, the formula is as simple. It's like a bank account where you put in money, the money grows, and at the end of the day, what is available to you is what is in that account. So it is a very simple arrangement compared to the other scheme, where we used to apply an actuarial formula which had some complexities in it, but this one is very straightforward. Your contribution plus the employer contribution plus investment income. And therefore, you can actually track your investment savings over the years of working. Every time you access your statement, look at that number down there. That is what forms your benefit. And therefore, you can keep on asking yourself, is that number sufficient for my retirement? And if it is not sufficient, then you have an option to do additional voluntary contributions. And Douglas did explain that. The fifth question is on what happens in case of death of a member of the scheme. Now, in case of a death of a member of the scheme, in the unfortunate event of death, then we are required to process and pay your benefits to your nominated beneficiaries. And I will underline the word nominated beneficiaries. What does this mean? Is that you as a member, you have an obligation in the scheme to ensure that you nominate the people that you want to be paid your retirement benefits. If you have a spouse, if you have children, or if you have other people who are dependent on you, kindly exercise this right. Go to our website, access a form that we call a beneficiary nomination form, fill that form, indicate all the people that you want us to pay in case you are not there. Assign them percentages. This is very important because that guides the Board of Trustees on how to allocate your benefits. So kindly, clearly nominate them, assign them percentages, and those are the people that we are going to pay in case you're not there. Even if you have minors, indicate their names and give us the name of someone, a guardian who want him or her to take care of your children. So please, it's a plea that we are making. We have realized that we don't have these forms for majority of our members. And therefore, every time we have a death claim, especially when there is a dispute, there is more than one people claiming your benefits, then it delays payment of your benefits in case of death because the board has to see it, it has to review the case for each one of them and determine who will be paid those benefits. You can avoid that as a member by guiding the Board of Trustees on who to pay. So how is this form submitted to us when you fill it? So once you fill the nomination of beneficiary form, you can either log into your portal. We will give you details of that portal and log into the member's account and upload that form there. That is the easiest way. We get that form immediately, you upload it. The other approach is that you can use our email address, which I'm going to share. It is info@pssf.go.ke. Once again, our email address is info@pssf, F at the end, not S, pssf@go.ke. If you send that form to us, we will send it to the administrator and it will be captured in your profile so that in case we need it, we can always refer to that form. So it is a plea, members, kindly go access that form. In case you're not able to see it on the website, do talk to your HR department. They normally have this form. You can fill it and send it back to us. Can you update this form? Yes, we advise you to update this form as frequent as possible. If your circumstances changes, for example, if you had one child and you are blessed with another one, always remember to include them in the form. So you can update the form as frequent as possible so that we have accurate information to assist the Board of Trustees in discharging their mandate of payment of benefits in a timely manner. The sixth question is, will there be a lump sum and a monthly pension? Yes, The law says that in case you retire, we will pay you a third of your, it's an option that is available. Most members exercise this option. We pay them a third of their savings in form of a lump sum. The balance of 2/3, which is like 67%, is payable in form of a monthly pension through an annuity arrangement or an income drawdown product. So to answer this question, yes, benefit is in two forms. In case of retirement, one is a lump sum up to a tune of 33%. The balance, 67%, is payable in form of a monthly income. So we have tried as much as possible to replicate what was applicable in the previous scheme. Finally, can I contribute more than 7.5%? Douglas explained this very well. Yes, you can do more than 7.5%. We encourage members to do that so that you increase your income replacement ratio, which is the percentage of pension that you get compared to your last salary before retirement. So members, if you can talk to your HR department and indicate the amount, it's very flexible. You can either do a percentage of your salary or an absolute amount. So you can advise your HR through or your payroll manager to make those deductions, which they forward to us. And you'll see them in your statement. So they are safeguarded, they are invested like every other contributions that you made, and therefore they earn you a return. Those are the frequent questions that we have been receiving mostly on our chats, and therefore we thought that we would maybe address them, but we are willing to take any other follow-up questions that you may have on this. Having said that, we have received a couple of questions in our chat box. The team has attempted to answer to some of them. We'll be checking if there is any that is left. But in the meantime, kindly allow me to invite the pension administrator to just tell us how we can access our pension statements. And for this one, I will invite Mr. Kogo, who is from the CPF, to just give us a quick remark on how members can access their pension statements. Mr. Kogo, karibu sana.
Thank you, Muli. Good afternoon, members of the scheme. My name is Solomon Kogo from CPF Financial Services Limited. We are the scheme administrator. As Douglas had made a presentation, you are able to access your statement through two channels. The first one is the USSD code *378#. So if you dial that code, you'll be able to register first as a member, then thereafter log in and be able to access your statement. In that code, you are able to see your statement, your full statement. However, the contribution statement can only give you the last 5 months transaction. If you want to see your full statement of contribution, you can use the second channel, which is the portal, members.psss, that is psss.or.ke. Go there and register as well. Then you'll be able to download your contribution statement plus your annual benefit statement. Currently, we have uploaded the statement up to 30th June 2022. However, we are currently running interest for the financial year ended 30th June 2023, sorry, and you'll be able to access those statements by 31st May 2024. So Muli, back to you. That's how members can access their benefit statement. Before I hand over to Muli, if you access your statement and you have any specific query regarding your statement, you can always write to us through the email provided in the scheme website. That is psss.info@psss.go.ke. Thank you, Muli.
Members, now it's time to address your questions. I will start by looking at what we have on the chat. Some of the questions that have been asked, I believe they are of interest to the other members, and therefore I'll just quickly run through them. And then if there's any member who was not able to type, we will give them a chance to ask a question. And therefore, if you have a question, you can raise your hand and then we'll allow you to talk and you can ask your questions. But in the meantime, allow me to run through what we have. So the first question is from Kanyiri. Kanyiri asked, is it possible to get a contribution statement? And yes, it is possible. To get your contribution statement, the administrator, through Mr. Kogo, has explained to us how we can get those statements. So please dial the code or log into the portal and download your benefit statement. If that statement has gaps or it has any clarification that you want made, feel free to write to us. You can do that through an email. You don't have to write a letter. Write an email to us on info@pssf.go.ke, and we are going to address the issues that the statement may have. The second question was for Ms. Mararo. Mararo asked, can someone increase his or her contribution? And yes, the answer is yes. We have answered that through the presentation. You can make additional voluntary contributions to the scheme, and these contributions will be very safe. Probably the other thing to mention about the AVC, the additional voluntary contributions, which may be of interest to members, is that you access these savings as a lump sum. So if there is any additional voluntary contribution that you have made as a member, you have an option at retirement to access all of it as a lump sum. So them, they're not subjected to the pension route. It's an option of the member. If you want to access them in form of a pension, you make that option or decision at retirement, but they are payable to you. The default option is that they are payable to you in form of a one-off lump sum. And they're flexible. You determine how much, and you can, in case you're not able to afford them any longer in future, you can always exit that arrangement and continue with your statutory contributions. What happens? This is from Sami Kimangu. What happens when one loses job? Does he or she get the benefits? Yes, very good question. Pension benefits in PSSS, they are payable or they are entitled to you, irrespective of how you exit service. Whether you are dismissed, whether you withdraw from service, whether you retire, whether you go on immigration, whether you pass on, those benefits are entitled to you. So you can join the scheme today, and maybe unfortunately a month or two down the line, things happen and you are no longer in government service. The amount that you had contributed is payable to you. However, there are limits in law on how much can be paid at that time when you have exited based on your age. If you have not attained the age of retirement, then we only pay you a percentage. The balance remains in the scheme until you attain your retirement age. But the 100% of those benefits, they are entitled to you. We pay a proportion when you exit, and the balance you come for it upon retirement. But you can also transfer. If you join another employer and they have a retirement scheme, you can transfer your benefits to that new arrangement. The third question is from Yvonne. How is the yearly rate of return or investment, ROI, for the contributions or interest model being used under the fund? Or what is the interest/gain model being used under the fund? So every year we declare an interest. This interest is declared based on a time-weighted approach. So we receive contributions over the year at different times. So the contribution that we received on month 1 in July gets more interest compared to the contribution that we receive on month 11 or month 12. And therefore we allocate interest based on when we receive the money, because that determines when we made investments to earn a return for you. Michael Wambua, you're asking what happens when employers don't remit contribution. So the Board of Trustees is required by law to enforce remittance of contributions. The employer is required to remit contributions by the 10th of the following month. In case they don't do that, the Board of Trustees takes enforcement action. One of those actions is to immediately engage the sponsor and find out why the contributions have not been remitted. They are also required by law, together with the administrator, to furnish that report to the Retirement Benefits Authority so that the authority or RBA can as well take action on their side. And those delayed payments, they attract a penalty at a certain percentage. Why is that penalty important? So that we can compensate the member for the time that they lost on investments. And therefore, eventually, when the employer pays the contributions, they are required by law to pay them together with some investment income or a penalty on top of it, which is allocated to the members' accounts. Please share the notes, Jemima. Please share the notes for reference services. We have access to your emails now, which is a very good thing from our corporate communications department. And therefore, we assume that by you giving us your emails, we have authority to use those emails to give you information regarding to the scheme. That information will include the slides that we have shared today. So yes, after this meeting, we are going to avail the slides to you. Yvonne Kibara, under what conditions are contributions withdrawable? So you can withdraw your contributions upon exiting from service. The condition here is that you must first exit from service. If you are still within government service, particularly within the confines of PSSS, that is a civil servant or a teacher or a police person, then you can't access your benefits. You can only access immediately you exit from service. And how much is payable to you at the point of access is subject to your age. So if you're below the age of 50, for example, we only pay you 50%. The balance of 50% will come for it when you attain the retirement age. Evelyn Zingili Mudengi, after tracking our statements as our old ministry, is a complete mess. Do you guys follow up on members' contributions? Because if members' contributions is not up to date, and God forbid anything happens to him or her, the next kin is the one to suffer, especially the young ones. Evelyn, we normally track your statements. As the administrator has said, at the moment, they've only updated those statements up to 30th June. 2022. The reason why they have not been able to update it further than that is because we were yet to declare the interest, which has since been done. And we are doing that in preparation for the AGM. So very soon, in the course of this month, your statements should be up to date. But notwithstanding, Evelyn, we encourage you to drop us an email, give us the details of the ministry and the challenges that you are facing. And as a secretariat, we are very gladly going to pick up the issue with the pensions administrator. So kindly send us an email on info@pssf.go.ke so that we can follow up on your issue. Please share the notes, Jemima. Yes, we will do that. I think these questions, we had attempted to answer them in writing, but mainly that is our response to them. I'm just trying to cross-check if there is any that we have left. Can I access my money if I take early retirement? Yes, you can access your benefits on withdrawal, on early retirement grounds, or on normal retirement grounds. And therefore, if you take early retirement, do apply through your employer for payment of your retirement benefits, and we are going to process them in line with the provisions of the law. That is from Etole Wilson. Omar Rashid, the website is actually not working. Omar, we want to apologize for this. We are currently trying to revamp our website. There's a team that is working on it. We want to give you much more information. We want to give you better options of interaction with the scheme. And therefore, please allow us some time as we work on the website. Very soon, it should be up and running. But we do apologize if we have caused any inconvenience to you and the rest of the members. So we are working on the website, and we have many other initiatives that we are doing to improve service delivery to our members. Why is it hard to access retirement benefits in this country? It takes unnecessarily long. Douglas said it, that PSSS is required by law to pay your benefits within 30 days. Previously, we had a challenge because it took us some time to onboard service providers, but now that we have them on board, we have started the process of fast-tracking payment of benefits. As at now, we are paying benefits between a period of 20 to 40 days. We still want to bring that down to 21 working days. It's our commitment to you as members, and we will endeavor to attain that commitment. Why are we able to pay you on time? is because you have your money. Unless there is remittance issues from your employer, so long as we have your money, your account is fully credited, we have no reason to delay payment of your benefits. We just access your kitty, we check what is there for you, the administrator does their calculations, and we process your benefits within 30 working days. How do we give benefits? How do we benefit from the scheme? This is a question from Dennis Makori. Do we give yearly dividends? Where can I get my statement from? Dennis, yes, we declare the interest every year, which is credited to your account. That you can sort of replicate it to dividends. It's only that we don't pay them, unlike the way SACCOs do. We top up your account so that your account keeps growing for you, so that when you retire, you have sufficient money for your retirement. So yes, there are dividends in form of interest, which are credited back to your account. How can I access my statement? I believe the administrator has explained that. Peter Oche, will we get the materials? Yes, we are going to circulate those materials. After paying the lump sum, this is Mararo. How long will one get payments? Will it be till death? Yes, once we pay you a lump sum, the requirement of the law is that we place you on a pension payment for the rest of your lifetime. Yes, so it's a lifetime payment of your pension. Peter Penda from State Council, what safeguards do we have to hedge from losses in investments? Now, the Board of Trustees, several safeguards are available. The Board of Trustees, number one, is required to come up with what we call an investment policy statement. This is a statement that looks at the profile of the members and advises on where the trustees can place your money in. So your investments have been safeguarded because the Board of Trustees are supposed to follow a statement. So they just don't invest your assets in asset class that is not guided by anything. So they're first guided by an investment policy statement. Secondly, the Retirement Benefits Authority has set up what we call investment guidelines, which also limit the places or the assets where your trustees can invest your money. And thirdly, which is very important, is what I said, that your trustees have a fiduciary role, which is a duty of care to ensure that your money is safe at all times. So there are several safeguards placed there under the law, and each one of them is meant to ensure that those your investments are very safe. So your trustees are limited, and the fund manager as well, they're limited in terms of the exposure that they can place on your savings. Alan Lagat, what is the difference between PSSF and NSSF? Because both are retirement schemes, and yet the law says you can't be in two retirement schemes. Clarify. Very good question, Alan. PSSF and NSSF, yes, they are two retirement schemes. Both of them are different and distinct. I think it's important we make that clarification. PSSS is an occupational scheme. It's a scheme that is open and admits people who are in public service. PSSS only admits teachers, police, and civil servants. And therefore, it is an occupational scheme set up by government for benefit of government employees. NSSF, on the other hand, it's an open scheme. It's a scheme that is open to all Kenyans. It falls under what we call Pillar 1 of provision of social security in this country. It's a mandatory scheme for those of us that are in employment. And therefore, it's a separate arrangement which provides a certain set of benefits. So when you exit from service, you claim benefits from both schemes. You approach NSSF to pay you retirement benefits from that side. You also come to PSSS, we pay you retirement benefits from this side. So both are two different schemes, distinct from each other. One is open to all Kenyans, the other one is open to government employees because it is an occupational scheme in its nature. Geoffrey Kirui, same question. I'm in both NSSF and PSSS. Can I opt out of one? As a member of PSSS, you are required by law to at least contribute Tier 1 contributions, which is a bare minimum level of contributions to NSSF, and therefore you cannot opt out of Tier 1. However, the PSSS Act has exempted you from Tier 2. Now, I know that's a bit complicated, but in very simple terms, in NSSF, there is Tier 1, which is some very minimal contributions, about 360 or thereabout, and there is Tier 2, which is majority of the contribution. So as a member of PSSS, you have been automatically exempted from Tier 2 contributions. You only make the first tier, which is Tier 1. Can you opt out of Tier 1? Unfortunately, no. The law requires you to make Tier 1 contributions to NSSF. And then you give us the other 7.5 at PSSS. Peter Pender, can I leverage my pension contributions for loan, either from the scheme or to other lenders? There is a provision in law, Peter, that allows you to use your pension savings as security for a mortgage. And therefore, that is the only route that is available at the moment. If you want to use it for any other purpose, unfortunately, it's not allowed, but you can use it as security to get a mortgage. I think I've made an attempt. Maybe the other questions I can invite my colleagues to help me. I can see we have run out of time. It's about 2:10. And I'm conscious about time. We had promised you to take about 1 hour, but because these are the questions that you've asked, allow us to attempt to answer them, and then maybe we can come to a close of this webinar as we prepare for the next one. We are saying that this will be a continuation, and therefore please allow me to invite my colleagues. Laban, maybe back to you.
We have 2 members that are waiting. We have 2 members that have their hands raised. So maybe we could usher them to ask their questions. We have Elijah Olayo, if you're with us. Elijah. We had Elijah and J and T. So we could allow them to ask their questions. Please unmute your mic.
Good afternoon. You can hear me?
Yes, we can hear you. Proceed.
Yeah, thank you for the opportunity that you've just handed to me. My question was, or is, does it mean that now the PSSF is taking over from the pension that is in Bima House now? And my second question is an area that you're not touching. You're saying after retirement, I'm eligible to 33%. Then the rest of the 67 is put in a lifetime payment. Is there for example, if that 67 I pick it for like 2 to 3 months, then of course there is a demise. What else? You're not addressing that, or does it mean after demise stops that? Remember, I have beneficiaries that are there. Please expound more on that area. Then I think the last question had been covered somehow, that you are going to share the slides, because I found Mr. Solomon Kongo, there was an SSD was sharing, but he was really very fast and faster than lightning in mentioning that SSD and the members' statement email. Thank you.
Thank you. Thank you, J and T. Muli, do you want to take that one?
Yes, Laban, I can take those questions. Am I audible?
Yes, proceed.
Thank you. Thank you for the questions. Sorry, I did not get your name, but I'm going to respond to them. So your first question is PSSF taking over from the pension arrangement that was offered previously under the pensions department? The answer is yes for the PSSS members. So if you are transferred to PSSS, maybe on the basis of your age, as at 1st January 2021, or you automatically opted to join, or you opted to join, not automatically, or you opted to join PSSS on voluntary grounds, then the obligation for payment of your retirement benefits from 1st January 2021 now rests on PSSF. So for those members, to the extent of those members, then that means that PSSF took over the obligation of payment of your retirement benefits for the period after 1st January 2021. For the members who are still under the old scheme, for them the payment continues. We also have pensioners and dependents who are receiving benefits from that scheme. So that scheme continues to discharge benefits for those members. And therefore, currently now the government has two schemes. It has the old scheme, which is paying benefits to the current retirees and their dependents, and the people that were above 45 who remained in the previous arrangement. And then we have PSSS, which is now paying for the people that joined PSSS. So we now have two pension arrangements from the government of Kenya. The other question is with regards to the pension. So we say that a third will be paid in form of a lump sum, 2/3 will be paid in form of a pension for the rest of your lifetime. But now the question that you're asking is very important. So what happens when you're in that arrangement and then unfortunately you pass on? So if that happens, maybe you had received your benefits for a given period of time, that arrangement offers you option. And let me start here, that when you retire, the pension is payable from two different arrangements. One, you can be paid through an annuity provider, or you can be paid through an income drawdown arrangement. If you're an income drawdown arrangement, again, I know that's a jargon which will continue to explain to members as time goes by. You access or you draw down your benefits after retirement. Every month or every quarter, you are paid a certain amount. In case you pass on, the balance in your account is payable to your beneficiaries. So that is the income arrangement. Now, if you have taken the annuity arrangement, which guarantees your lifetime payment, at the point of you selecting that product or getting into that product, then you determine the period when you want that product to be paid. You can select maybe a 10-year period or a 20-year period when you want it to be guaranteed. We call it a guaranteed period. So that if, for example, you've selected a 10-year guaranteed period and you pass before the end of those 10 years, then the balance of the 10 years is payable to your beneficiaries. However, remember, as we've said, it's a lifetime product. So long as you are still alive, you as a member, you are paid until the unfortunate event of your death. So if you survive for the next 30 years or 40 years, you'll still be on payment. But if your guaranteed period was 10 years and something happened in between, then the balance of those years is payable to your beneficiaries. And it's important for members to appreciate that this is an option that you select at the point of retirement. We will keep on sensitizing you, and that's why we are saying that these seminars are very important, and these sessions, our interactions with members. So we'll keep on sensitizing members on the options that they have when they retire. But in very simplistic terms, those are the options that members have. The other one was on the USSD. You've said that the administrator was very fast in saying those numbers. We are going to share the slides. They have the USSD code. But nonetheless, we can give you that code again together with the portal so that members take note of the two. They are very important. So Laban, if you'll allow, you can just share the USSD again and the portal so that members can take note of them. And we do apologize if we were fast in presenting that. Thank you. Hopefully I've answered the questions.
Thank you, Molly. I think in the interest of time, we had this webinar scheduled for 1 p.m. to 2 p.m. Kindly members allow us to end the webinar at that point. The USSD code is *378#. And the member portal is www.members.psss.or.ke. So you can monitor the contributions on those platforms. So thank you very much, members, for attending our first webinar. Just two announcements. This is the first in a series of webinars that we have. Of course, with the guidance of our trustees, we are going to announce to you the date of the next webinar, preferably bi-weekly or monthly, but we'll take the guidance of our trustees in terms of how we engage with you through this platform in the coming days. In terms of the AGM, just a reminder that we'll have our second annual general meeting on the 7th of June. The physical component of that AGM will be at the Kenya School of Government. Members can also follow through the various online platforms that we provide, and we'll share with you on email the link to attend that virtual AGM. So thank you very much, members. Thank you, John Moody. Thank you, Douglas Asanyo. And thank you, Solomon Kogo, our CEO, and our trustees for our participation and contribution in this webinar. Asanteni sana, members. We look forward to engaging with you in subsequent webinars, and we shall communicate the date of those webinars. Asanteni sana. Have a nice afternoon, and may God bless you. Asante.
Thank you very much, Laban. Good afternoon, members.